So this will be a number of people here today. I want to start off with some new material. Don't forget our next meeting is
Monday.
Monday, in the next room through the wall there, 118. So luscious room with nice windows and stuff too. So we'll be meeting then, and somebody asked me on Tuesday, how long will that session take? Well, however long it takes, we're going to basically do a final exam review. We can do it at a leisurely pace. I'll answer any questions or anything else that's necessary. But I must confess here, it probably won't take the full time, but if it does, it does. If it doesn't, give you a chance to get home and start studying sooner. So look over all the material. We have a lot of hard material today again, everyone. And I want to start with some of this new material, especially the Chapter 12 stuff. Then we'll look at your exams from last week. Then afterwards, a lot of the stuff on the board here, this is all Chapter 14 stuff that I went over again on Tuesday, and they seem to be picking it up in the other class, which is encouraging because the other class has not been performing slightly as high as we've had in here. So I'm encouraged by that. We'll do some administrative stuff a little bit later as well, but why don't we start some new material here. And we're going to start with an old handout that's really very valuable in my opinion. It's got some very interesting aspects. One of those is two-sided, the other is single-sided. Did you buy the study manual?
Yeah.
Yeah, I used to require that.
Really?
I thought it was pretty good.
I just saw it on the internet, and I'm happy I did it because there's extra problems and stuff.
Oh, exactly. No, I always liked it, and then they quit putting it in the shells. So, but it's a handy tool, and it's a nice reference even when the class is over.
Yeah, that's why I got it.
All right, let's take a look. Which of the following are capital assets? If they're not a capital asset, what are they? I'll do the first one, then I can look for volunteers for the remainder. U.S. savings bond, I'm going to say no, because you buy them at a discount, and then the difference between what you paid and what you collected, what you paid versus what you collected, is interest income. But let's get some help. Number 2, your personal automobile. Capital asset or no? Someone take a chance.
Yes.
Yes, it is. Personal use assets are capital assets. Very good. Number 3, a parking lot used in a business.
Yes.
No. It's code section 1231. Now, 1231 assets, remember, are non-realty and realty used in the trade or business held for greater than 12 months. What? Now, so 1231 is the broad umbrella, but there's 3 subdivisions under 1231. Anyone remember what the 3 subdivisions are? It's on the board last week, but everyone's brain was probably fried after the exam. What are the 3 subdivisions? I think Tracy's got it.
1245, 1250.
And other 1231. 1245, 1250, and other 1231. If this were a paved parking lot, what would be the subclassification under 1231? Paved, like a lot out front here. 1250 is correct. Donna's right. It'd be 1250. What if it's gravel or dirt? Other 1231. Everyone with us? If you need us to repeat,
what's under other 12?
Oh, the only thing I had under other 1231 was land and unimproved parking lots. Those are the only two I can think of off the top of my head.
So you said this, anything 1231 is not a capital asset?
Yes, let's follow up on Donna's thought. That's going to be a little bit confusing today. 1231 assets are not capital assets by definition. But as we'll see a little bit later behind me, here on the whiteboard, they might receive long-term capital gain treatment. Bill, that seems inconsistent. They're not capital assets, but they might get long-term capital gain treatment. And that's via like the back door, the 1231 netting rules. Some of you researched this last week for the online discussion. So we got some interesting material today. And another differentiator between those people who go into tax and kind of relish it and everybody else who's confused as hell and say, boy, I can't understand this. Okay, any other?
Well,
Yes, go ahead.
I just don't get, okay, I work in fixed assets and we capitalize machinery and equipment, furniture and fixtures.
And machinery and equipment, furniture and fixtures would be?
1245.
They'd be 1245. So they are capitalized for financial statement purposes, but they're not capital assets for income tax purposes.
Okay, so that's the book.
Yes, it's a matter of, that's a good point. I know Vernesia, the other class, is always saying, well, Bill, for accounting, it's, and I say, whoa, this is tax. This is tax, and some of the terminology is different. Yes, those are capitalized assets. Those are fixed assets for the books, certainly depreciable. Here, though, they are not capital assets with regard to capital gain and loss treatment. That's what makes the tax law so stimulating. Well, I like them anyway. All right, everyone, let's keep going. Autobiography owned by the author, number 4. Capital asset or not a capital asset? Person wrote a book about their life.
There's something about this, wasn't it? There's something about that ownership by the author, right?
Yes, that is correct. Tracy remembers.
I'm not sure which one it is, but
yes, it was artistic works received from the hands of the creator. Remember my little drinking bout with Pablo Picasso? Yes, so the answer here is no. That would be ordinary income. Number 5. A coin collection accumulated as a hobby.
yes.
Yes, that's an investment asset. Your stamp collection, your baseball card collection. Now, what if I were and I hope I get the word right, a numismatist? What's a numismatist?
Somebody who studies coins?
Well, somebody who deals in coins. It's like a stamp collector is a philatelist. Well, these terminology. I remember once at one of the lower income neighborhoods, a foot doctor is a podiatrist. But nobody in that neighborhood would have known what that was. If they said, Dr. So-and-so podiatrist, so they put down their foot doctor. Then people will know. But if you were a coin dealer, then, of course, number 5 would be no, because that would be inventory. But it did say here as a hobby, so you were correct in saying it's a capital asset. Thinking of that, number 6, automobiles held by a car salesman.
Inventory.
Inventory, so the answer is no, that's inventory. Number 7. Note receivable sold by a retailer to a collection agency. Yes or no?
No.
No is correct. Accounts and notes receivable from the ordinary course of business are not capital assets. Cross off 8. I don't know 8 myself, so without looking it up. We're not doing any strip mining here. So cross off 8. Go to 9, though. I like 9. Fixtures in a retail store.
No.
No. That's a 1231 asset. What subdivision of 1231 would that be?
1245.
That is correct. 1245, Donna's right. That's a 1245 asset, so the answer is no. It's 1231, subdivision 1245. Number 10, I think we need to know a little bit more. A valuable oil painting acquired by gift. What do we need? What else do we need to know?
Who gave it?
Who gave the gift? Don is right. Let's say you got that directly from the artiste. Then it would be
Capitalized.
not a capital asset. Remember, artistic works received from the hands of the creator. But what if you got it from your grandma and she wasn't Grandma Moses? Remember Grandma Moses? Oh, a number of years ago, she did these real juvenile paintings, but because she was a real old lady, you know, they became, well, you would probably know more about with art history and stuff, and it became very prominent. But if your grandmother, and she was not the artist, gave you the oil painting, then it would be a capital asset.
Is that an investment asset as well?
I would assume so. And let's face it, so many people are paying large amounts for items. I remember when Bill Clinton was running for president the first time. Helen, I was still married then. Helen and I were in Pittsburgh. We went to Pittsburgh for a Cubs series. And we were staying at a hotel. And then we found out when all the security was all over the place that Bill Clinton and Hillary were staying there also as he was running for public office. And he was giving out autographs. I talked to him briefly and shook his hand, but I wish I'd got an autograph because then I could have probably put it on eBay and got money for it. But if I sold it on eBay, not a capital asset because I got it directly from Bill. I remember, of course, Helen, you know, being a female, being more astute than me. The next morning when we saw them, Helen said, "Boy, does Hillary look old." Now that was in the 90s. You know, now here we're 20 years later or something, now she's running. And then number 11, a letter written by Abe Lincoln that was acquired, let's say by you, by inheritance. Yes, that would be a capital asset. Now, if you were John McCain, I might be suspicious. Because John McCain might have gotten the letter directly from Abe. I'm just kidding. He's an older gentleman. Just kidding. All right, you did well on that. Let's continue. The next one, guy has a drugstore. Same questions. Problem 2, number 1. Vacant real estate purchased for use as a parking lot for his customers. Capital asset or not?
No.
No. What type of asset is it if it's paved? What type of asset is it if it's unpaved?
Paved is $12.50. Unpaved, other $12.50.
Perfect. This came from the old CCH text that I used to use that was a little bit higher level than ours. But ours is good. And they love parking lots. Number 2, T-shirts that have been in your store inventory for at least 6 months. No. Let me change it. T-shirts that have been in your store inventory for at least 2 years. Still no, that's right. It's inventory, regardless, very good, regardless of the holding period. Third one here, a note receivable given in payment of a balance due by a customer's account. No, that accounts and notes receivable for the ordinary course of business.
Wait, I'm sorry, 2 you said no?
2 is no, it's inventory.
It's inventory, yeah, okay.
And notice
Sorry.
holding period does not matter. I always try and fool someone by changing the holding period to 2 years. Sometimes it works. The other class was too astute on that as you were as well here. It didn't fall into Bill's trap. And number 3 was no because that was notes and accounts receivable in the ordinary course of business. Number 4, 100 shares of foreign corporation stock. No. Ooh! No, why? Or is it yes? If I have stock in the Netherlands, Antilles, Dutch Shell Petroleum, or whatever it's called, isn't stock a capital asset? Foreign corporation stock or domestic corporation stock is a capital asset. It's an investment asset. Doesn't matter nowadays. There's so many companies now that, companies here in the U.S. now that have a foreign parent corporation.
So it's yes?
So it's yes. So number 4 would be yes, whether it's foreign corporation stock or domestic corporation stock. Stock, like corporate bonds, are investment assets and are capital assets. And that's probably outside of your home and your personal vehicle, those are probably the most likely capital asset that you personally would own. Like stock of the company that you're working for. Your home, number 5. Yes, personal use assets are capital assets. All right, well, let's continue on. A guy bought some land, held it for 12 years. Look how old these problems are. And then sold it at a gain. What's the nature of the gain? Held it 12 years. What if he's a real estate dealer selling real estate? What would be problem 26, part 1? What would be the nature of the gain? A real estate dealer selling real estate. Isn't like a car dealer selling cars. What's the nature of the gain?
Capital loss. Yeah.
Well, I mean gain. It says it's gain. Tracy's saying could it be capital gain? But notice this is a real estate dealer dealing in real estate. Isn't this the equivalent of inventory for the Pulte homes or something? So ordinary income. This is ordinary income. It's a land dealer dealing in land. Now, though, Tracy, take the next part. What if he held it as an investment and sold it at a gain?
Yeah, long-term capital gain.
That's right. Tracy's right. LTCG. Save yourself some writing. Long-term capital gain. Part 3, what if he used the land to build his house on it, and then he sells the land, let's say to a developer who's going to knock his house down and build some commercial establishment there. So his home was on this piece of land. So what would be the nature of the gain? Remember, the land that your house is sitting on is what type of asset? Or is that a capital asset or not?
Other 1231.
It's not a trade or business. Remember, you told me earlier.
This is land and trade of business.
No, this says the land.
No, other 1230, other section 1231. I didn't have this in my notes. I don't know.
Okay.
Unimproved parking lots of land I have.
Yeah, but let me explain this one. Remember how we said in problem 2, part 5, we said his home, and you all said capital asset. So the land your home is sitting on is also a capital asset. So if you sell your house and you sell the land that's under it, let's say to a developer or to the county. I was thinking about Route 53. I didn't see it today, but yesterday it was still closed by the Morton Arboretum for flooding. A few years ago, there were a whole bunch of houses there, and the county came in and said, if you want to sell your house, we'll pay you a good price because if we tear some of those houses down, maybe there'll be less flooding. Well, there is less flooding, but it still floods. Some people didn't want to sell. So you sold your house to the county because you're tired of having to get to your house periodically by rowboat. That would be capital gain.
So
because, yes, go ahead, Tracy.
But if you sell the land, is that subject to can you still exclude the 250 as part of that?
Interesting aspect. Excellent. I would say yes, because I would say the sale of your principal residence
wait a minute,
in our area would include the land that it sits on.
But if it was just land, don't you have to live in it for 2 years?
That's for the 250,000, 500,000 are exclusion.
That's what I'm saying.
Yes.
So could this, so you couldn't.
This was 12 years here, though. Remember, you bought it.
Even if you're not living, if you just you held this land to build a house on,
okay, I get it. Tracy's saying, what if he had planned, he bought some land, and he planned to build his house on it, and then he never did? Then it would be an investment asset, wouldn't it? Yeah, that's an excellent point.
Not subject
I
to
was
the
making the
exclusion, though. You
assumption.
still have to-
I was making the assumption that his house was placed on that particular property. Did everyone see what we're saying here? If you bought a piece of land and built your home on it, then you sell the property, the land and the house, that's all capital gain. And that all would qualify for the $250,000, $500,000 exclusion. If you bought the land with the intention of building a home for yourself, but then you never did, then it might be treated as an investment asset because you never occupied it as your principal residence. What about this? You know, here, some of you own homes or townhomes. Do you own the land underneath the building? Well, usually. But out east, it's not uncommon for people to buy a home, but they lease the land that's underneath the home. Somebody else owns the land. So there we'd have a different type of scenario than we have here.
So it would be ordinary income if that $10,000 gain would be ordinary income if it was an investment asset.
Well, if you were the person who owned the land that a lot of houses were on, you could be deemed to be in the trader business of owning land and then leasing it to homeowners. That might make it ordinary income. But
No, I mean, if you just held, like we said, the land to build a house on,
oh, yeah.
never built the house, and you
That's-
sold at a $10,000 gain 12 years later.
I
that's
would
gonna
argue
be-
long-term capital gain there. Because even though your intention was to make it the location of your principal residence, you never did. You never built on the lot. There, I think the actual usage of the lot, and as you mentioned, the 2 out of 5 years would prevail. Other ideas on that one? All right, well, one more part to this, then we get really stimulating. Oh, yes, Donna?
So if it's a trader business related thing is
Then it would be
okay.
1231 gain or loss. The options here for this problem are ordinary income, long-term capital gain, or 1231 gain. Those are the three options. We said number one was ordinary income because that was in land, was an inventory item. 2 was long-term capital gain. 3, I was assuming that you actually built your home on the property, so your kids had their swing set and everything there. So I was saying long-term capital gain in that regard. And then Tracy brought up whether we would qualify for the exclusion. And what if you didn't build your house on it, in which case it'd be an investment asset, still would be long-term capital gain. And number 4, what if you owned the lot and it was next to your fishing tackle shop and customers parked on that lot? What would be the nature of the gain for problem 25, part 4? This is a lot that is next to a fishing tackle shop where people who are buying tackle and stuff will park their cars. Go ahead. It's 1231. Margaret's right. It'd be 1231 gain. Section 1231 gain. That stimulated us a little. Wait till you see this next one, and then we'll stop and go to something else temporarily. Problem 30. Indicate the nature of the gain or loss. Now, what are our choices here? What are our choices? Ordinary income or ordinary loss. That's one possibility. Ordinary income or ordinary loss. Capital gain or capital loss. Capital gain or capital loss. Or 1231 gain, 1231 loss. 1231 gain, 1231 loss. And for each of these, let's add one additional day. One additional day. All right, these are trickier. Okay, number 1. Sale of land held for investment for 5 months and 1 day. What would be the nature of the gain or the nature of the loss? Go ahead, Amy wants to say something, I can see.
Short-term capital gain?
Short-term capital gain or short-term capital loss. Amy is correct. Why don't we do this? Once somebody successfully answers, then they're out of contention for the remainder. Then we'll give everyone a chance. So Amy is correct, short-term capital gain or short-term capital loss. Okay, somebody other than Amy. Number 2, sale of land held for use as a business parking lot for 12 months and add 1 day.
1231.
That's right. Okay, Tracy, 1231 gain or 1231 loss. Okay, 2 people now have been exempted. This gets more exciting when we get down there at the end. Unfortunately, there's one extra person who's going to get cheated. Okay, 1231 gain or 1231 loss. Number 3, I grabbed this one if I were you, it's easy. Sale of land held for 14 months and 1 day by a land dealer in the ordinary course of business. All right.
Ordinary income gain or loss.
Okay, ordinary income, ordinary loss. Somebody tried to get it over here, but it like Jeopardy, they were too slow on the buzzer.
She could have it.
No, that's all right. Ordinary income, ordinary loss. Now, number 4. This one should be worth more points. Sale of land held as a business parking lot for 5 months and 1 day. Well, normally it'd be 1231 gain or loss. What's the problem here?
The time frame.
The time frame. The time frame. I had an example on the board last week where I said a truck used in the trade or business held for 9 months and was sold. Now, Bill has his own unofficial name for this that I would not use with the IRS agent.
Limbo.
Limbo, yes, that you get credit. All right, Margaret. A limbo asset, but that's Bill's term, but on a limbo asset is ordinary income, ordinary loss. So if something would be a 1231 asset, because it's real or personal property used in the trade or business, but it is not held long enough, that's ordinary income, ordinary loss. It's in limbo between 2 worlds. Kind of like being in purgatory or something. You're either going up or down. You're out of in the middle there. That was very good. So we'll give credit over there to Margaret for that one. Okay, number 5. Sale of land held for 12 months and 1 day as the taxpayer's personal backyard. And let's assume the taxpayer actually had a house built on that particular property and then sold it at either a gain or a loss. He sold the entire property with the house. Yes, go ahead, Donna.
Capital gain or loss?
Well, half right. Long-term capital gain, or what happens if you sell your house on a lot at a loss? What happens when you sell a personal use asset?
You can't deduct a loss.
Can't deduct it. So yes, so we'll give you half credit for that though. Long-term capital gain, personal non-deductible loss. Life is tough. They get you on one side. If you get a gain, they slice you on it. You take a loss, cry away. Very good. Okay, number 6. Still got a few people over. We need to respond over on the other side of the room there. Sale of a machine held for business use for 12 months and 1 day. Go ahead. I disagree. She said capital gain or loss.
1231.
It's 1231 gain or 1231 loss because a machine that's used in the business is a 1231 asset. What subdivision of 1231 is it?
45.
1245, yes. See how tricky these are? See why tax stands out? You know, it's a nice occupation if you can stomach it, I'll tell you. Okay, number 7, and we still got some eligible people over there. Fellas in the back row here, you guys gotta, come on, Nishan, CJ, we need you. Sale of a machine held for business use for 4 months and 1 day. Go ahead. That's right. Ordinary income, ordinary loss because it's in limbo. Very good. Suji, I cheated you out. You didn't get one. I'll have to hold one for you coming up. Okay, what do you think of that? Well, I didn't have a chance to really look it over that closely. I was working on the paper. All right. Now, we're going to go back to this handout, and I got some answer keys for that handout in a little bit. But I want to go into depreciation recapture next. And I do not like the way most textbooks handle this at all. So when you don't like what they're doing, you do something yourself. We'll do a little history here. Bill loves history. Some of you have been looking at tax history, but I'm talking now about U.S. history. Before the Tax Reform Act of 1961, there was no such thing as depreciation recapture. Who was the president in 1961?
Kennedy?
Kennedy. That's right, JFK. Probably nobody in this room but me was born then, but I'm sure you've seen pictures and so forth and know about it. It's just like somebody asked me the other day, Bill, when Kennedy was assassinated, what were you doing? Because that's something that everybody remembers. I was in math class. I was in high school, and I was in Captain Hilgard's class. It was one of the advanced math, and somebody came in and opened our door and told us about it, said he had just died, and then, of course, the rest of the lesson we just talked about assassination or deaths of presidents every so many years in office. But it's kind of like if someone says, what were you doing when you heard about 9/11? Something that you'll always remember. But anyway, this is before the assassination. That was in 1963. And I can see the rationale. They decided to create depreciation recapture for Section 1245 assets. Now, over here, depreciation recapture only applies to gains. Does anyone know the form number that depreciation recapture appears on? There was one student in the other class who's done tax work who actually knows the form. But I doubt if many of you have seen it. It's a unisex form. The same form is used for all types of taxpayers. Individuals, fiduciaries, corporations. Well, write it down, and you can check it at irs.gov. It's the 4797. 4797. The back side of it is the recapture. You look at it, it says like Part 3, and it says gain from the disposition of assets under 1245, 1250, and then 3 other sections that are not of interest to us. One of them deals with reforestation. Another one deals with intangible drilling. So the front side of the 4797 is the 1231 netting rules that we'll be looking at in a little bit, or maybe a half hour from now. So the 4797, if I had this type of situation, I would file the 4797. If DeVry Education Group, a corporation, had it, they file the same exact form. So it's not like Schedule D, where remember there's a separate Schedule D for each type of entity. It's Schedule D, but it's a different form. This is a unisex form. Now, let's go to the bottom of this handout. Let's do the easy part first, then we'll look at some supplemental problems. I have a machine used in the trade or business, so that's 1245. Selling price, $96,000. Cost was $80,000. I took accelerated depreciation of $32,000. So my adjusted basis was $48,000. I have a gain of $48,000. Now, look where I have down all taxpayers. This rule is very simple. All taxpayers must recapture all depreciation taken. Now, on the board, although I'm blocking your view now, recapture is converting what otherwise might be long-term capital gain into ordinary income. This is where Donna brought up an interesting point earlier, talking about, well, if these are not capital assets, how come they can get capital gain treatment? That's the 1231 netting rules we'll be looking at. I said there's some hard material today, but stimulating. So I think the rationale here is this. When you depreciated this machine, you got a deduction for depreciation that reduced your ordinary income. So therefore, why should we let you, when you sell the equipment, get long-term capital gain? You got a deduction against ordinary income, so therefore you should not be able to realize long-term capital gain, at least to the extent of the benefit you got out of the depreciation deduction. Now, I didn't go back and look at the committee reports for 1961. I'm sure they're in some kind of paper documents, because this goes way so far back. But I think that's the rationale behind it. Under 1245, look at tier A here. There's two tiers of gain. 1245 recapture, what does it say on my sheet here? Down at the very bottom. All depreciation taken. Very easy. You recapture all depreciation taken. How much depreciation was taken here? On this thing at the bottom of my example. 32,000. So of the gain of 48,000, 32,000 will be ordinary income. That's the recapture. Anything that's left over, tier B, 1231 gain, that would be 16,000 probably, but we haven't explained why yet, long-term capital gain. Take a look at that example, then we're going back to the supplemental problems, and I'm going to pass out an answer key here. And we're going to take another closer look. Does it make sense? But one thing we haven't seen yet, and I have it in red, recapture cannot exceed the gain realized. We're going to see that in just a few minutes, because this is a reclassification, and you can't reclassify more than the total gain. All right, well, let's go back now and look at some numerical examples. Let's go to our original supplemental problem sheet, and we'll go to the back side or second page, based on if you have a one-sided or two-sided copy. And let's look at problem 11. Problem 11. And you can look up the answer key for problem 11 as well. Going to do a lot of shuffling of paper today. So we're looking at problem 11 and the answer key for problem 11. And we're going to look at 1245 recapture, so we understand it fully. Then when we do, we're going to take a step up and look at 1250. All right, Guy Morris. Everyone find Guy Morris. He bought a machine in '92 for $30,000. He deducted $7,500 of depreciation for tax, apparently accelerated depreciation, because it says straight line would have been $5,000. 2 years later, he sells it for $36,000. First question I want to ask you is this. Is there any significance to the phrase straight line depreciation would have been $5,000? What is the recapture rule for 1245? What do we recapture again? What did we say on Bill's sheet? Everything. So 7,500 is what he depreciated. So what straight line would have been is irrelevant. Now, the reason that's in here is when we talk about 1250, that would be crucial. So they're trying to have you confuse 1245 and 1250. Now, let's be honest. I had a student talk to me after class on Tuesday night. And he said, Bill, how do you get to understand this best? And I said, to be truthful with you, it's actually doing it. Doing it. I mean, in academia here, and to get you through the CPA exam, we're throwing 5,000 rules at you every week. The way to best understand this, have these situations. I mean, I know these by heart now because I've had 1245 assets for years. And that's always the case, on-the-job type scenario. That's why when I took the CPA exam, I'd already worked in taxes for 2 years. So the tax part of the exam was really easy for me. Might not have been as easy if it was right out of school. Because at the time, they didn't have that 150-hour requirement. You know, you could take, a lot of people took undergraduate seniors, senior year, the last semester, they took the CPA exam because you could do so at the time. Obviously now there's different rules. So let's take a look at the answer key. The answer key is at the bottom of the page here, and we'll take a look, see what it has to offer us. What would be the nature of his gain? How much gain would be recognized? Okay, it says the amount realized was $36,000. Cost was $30,000. $7,500 of accumulated depreciation was taken. Adjusted basis $22,500. Total gain $13,500. How much depreciation was taken? Everyone. $7,500. So $7,500 would be ordinary income. That would be the 1245 recapture. The other $6,000 is Section 1231 gain that might receive long-term capital gain treatment. That's this over here that we'll look at later. Net all 1231 gains after depreciation recapture. So that would be the $6,000. Let's look at part 2. What if the selling price was $28,000? $28,000 amount realized. Cost was $30,000. $7,500 of accumulated depreciation. Adjusted basis $22,500. Gain $5,500. What was the potential recapture here? Potential. $7,500. Don is right. But, as Bill wrote in red, although he's blocky with his big body, the recapture cannot exceed the gain realized. So therefore, the recapture here is only $5,500, and it's all ordinary income. There is no 1231 gain. Okay. Now let's stay with this supplemental problem sheet. Go to the very bottom, the one at the bottom, problem 13. And you can look up the answer key if you want to as well with this other handout. Corporate taxpayer. But notice under this section, it doesn't matter if it's an individual, a fiduciary, or a corporate taxpayer. Bought a machine for $80,000, accelerated, bless you, accelerated depreciation of $32,000 was deducted. Straight line would have been 24. What's the significance of the 24? Not relevant at all. Margaret's shaking her head. She's right. Irrelevant. Taxpayer sells the machine 8 years later. Skip part 1. Let's look at parts 2, 3, and 4. Sells it in part 2 for $96,000. Sold it for $96,000. Cost was $80,000. Tax depreciation was $32,000. Adjusted basis $48,000. Total gain $48,000. How much do you recapture? What was the depreciation taken? $32,000. So $32,000 is ordinary income. The other $16,000, because the total's got to be $48,000, 1231 gain, probably LTCG. All right, look at part 3. Sold it for $55,000. Cost was $80,000. Accumulated depreciation $32,000. Adjusted basis $48,000. Gain of $7,000. What's the recapture? 7. This is like the problem we just looked at, exactly. The recapture cannot exceed the gain realized because we can only reclassify the total gain. Let's look at part 4. Remember, next week, if there's any questions about these issues, once you kind of chew on these a little bit, have a little bit of rosé wine or something, looking this over, next week we're wide open for answering questions. One benefit of having a meet in week 8. Amount realized, 45. Cost was 80. Accumulated tax depreciation, 32. Adjusted basis, 48. Loss of 3. What does part 4 tell us? Why is part 4 of value for learning purposes?
Because you can't, it has to be, you can't take more than the gain realized. So if there's no gain realized, there's no.
Well, there's no recap. Recapture only applies to what? Gains. Gains. Take a look at that 4797 form. Part 3, second page. Gain. There's no recapture on losses. No recapture on losses. I think that's pretty straightforward. For you, you've never seen this before. I'm sure you've never dealt with recapture. Some of you have done some tax work, different tax services. If you did individual work, I imagine the individuals you handled never had recapture. Individuals can have these types of assets, but normally that's not the normal person. These are more corporate oriented. Okay, well, let's put that aside temporarily. Right now, we're going to go back to that later. And we'll go back to the recapture sheet. The recapture sheet. And now we're going to go up to a little bit later period of time in U.S. history. And we're at the Tax Reform Act of 1969. This is the one that gave us all those elaborate rules for contributing appreciated property to a charity. Remember option 1 and option 2? Part of that legislation. Who's the president now? 1969. Nixon's, right? You got it right away. The other class thought it was Jimmy Carter. No, sorry. It's Tricky Dick. It was the first term, not the Watergate term. That was the next term. So, now originally, the rule was very easy for 1250 recapture. And basically, take a look at this. Take a look here where it says trust or estate. See where it says trust or estate here on this handout? Well, let's go to the very top first. We have a building used in the trade or business, so that's a 1250 asset. Selling price $550,000. Cost was $500,000. This was an acres building because we could take accelerated depreciation of 1/16. Straight line would have been 64. Now we need that information. When we saw it on a 1245 problem, we just threw it out because it was meant to confuse us. Now we need it. Adjusted basis 384, gain 166. Go down to where it says trust or estate. That's the so-called fiduciary. How many tiers of gain do you see there under trust or estate? How many tiers do you have? T-I-E-R-S, hopefully, not T-E-A-R-S. 2, A and B. A says 1250 recapture. The excess of accelerated over straight line. If you took accelerated depreciation, you have to recapture the excess of accelerated over what straight line would have been. That'll be ordinary income. Anything that's left over is section 1231 gain. Total gain minus the total recapture. Here it's $114,000, probably long-term capital gain. Now, that was the case for corporations and for corporations through the end of 1984, and for individuals through the end of 1997. Pretty straightforward. Think about this. Under makers, what is the only allowable depreciation method under makers for tax? What's the depreciation method that's in the tables that we looked at for maker's depreciation for real property? Remember the 3.636 that appeared so many times? Okay. Straight line.
It's straight line?
Straight line. That's straight line. That's 1 divided by the life. That's straight line. Since 1987, or 12/31/86 on, real property can only be depreciated using straight line. The only issue is it 27.5-year property or 39? It's all straight line. So if we had a maker's building where they could only use straight line and it was sold, what would be the recapture, if anything, on the sale of that building by a trust or estate? What would be Tier A if they only could take straight line? What would be Tier A? Sujay, what would be Tier A if they only took straight line?
Be nothing.
Be nothing. Be zero. Because there'd be no excess of accelerated over straight line because you took straight line. So notice today, if a trust or estate, the so-called fiduciary, sells a maker's building, that's a 1250 building, there will be no recapture because they're only allowed to take straight line and there'll be no excess of accelerated over straight line. So it'd be all 1231 gain. See how that works? Bill, this is confusing stuff. I know it is. All right. That's still the rule for trusts and estates. Now, corporations, C-corps. We have to go forward. Now, some of you, I'm sure, will know this era. The Deficit Reduction Act of 1984. Who's the president now, 1984?
Reagan.
Reagan, the conservative hero. Now, in the 1984 Deficit Reduction Act, as revised in the 1986 Act, from 15 to 20%, notice if a corporation sells a 1250 building, how many tiers of gain do you see here under corporations? How many tiers? 3. So let's go back and let's look this over, and then we'll talk about a potential problem on the final exam in this area that a third of you may get. Selling price $550,000. Cost of the building again was $500,000. Accelerated depreciation was taken because this was an acres building. 116, straight line would have been 64. Adjusted basis 384, gain 166. Now looking at corporation, we know Tier A, it's the excess of accelerated, which they were allowed to take if this were an acres building, minus straight line. So that's the same 52,000 we had for the fiduciary, the trust or estate. That would be ordinary income. Tier B, it's a separate code section, 291. Now, if you read that code section, it doesn't read in English, it reads in legalese. But the gist of it is, you have to recapture 20% of what straight line depreciation would have been. Straight line would have been 64,000 here given. 20% of that is 12.8. Tier A plus Tier B are the total recapture, 64.8. Anything left over, which would be 166 minus 64.8, is long-term capital gain, 1231 gain.
In the real world, wouldn't software calculate all this for us?
Hopefully correctly, yes. Anytime there's complex tax bills, remember who benefits. Lawyers, accountants, and the software people who've got to redo the software to reflect this. There have been some situations where after tax law changes, the software was erroneously prepared and modifications had to be made. But yes, and thank goodness, because think of the, buildings, there wouldn't be that many sales. But like on equipment or something, you could have a large number of sales. Now, on the exam, one of the possibilities will be a corporation selling an acres building. But let's say this were a maker's building. Help me out here. If a building were depreciated under makers, would there be any recapture?
No.
Yes.
Acres? Or
Under
acres?
makers. Under makers. Remember, we said if a trust or estate sold a maker's building, because they can't take accelerated, there would be no recapture. But if a corporation sells a maker's building today, would there be recapture? Yes. Would there be tier A? Excess of accelerated over straight line. Would there be tier A? Well, no, because they can't take accelerated under makers, so be 0. But would you have tier B? Yes. A C corporation selling a maker's building where they only could take straight line depreciation will still have recapture equal to 20% of straight line. Now remember, what was the purpose behind that? That doesn't make as much sense as the 1245 recapture. It's to raise revenue. It's a revenue raiser. Now, what might happen on the exam? We'll talk more about this next week, but like Tracy may not be here next week, so chances are she won't. So we'll give her a little bit of guidance here. What if on a question in the problem part of the exam that 1/3 of you would get, so not everyone would get this, we had a corporation selling a 1250 asset. And it's an acres building, so they took accelerated depreciation. We don't know what straight line would have been because we don't know the life of the building. Remember, under acres, buildings going to either have 15, 18, or 19-year life based on when they were put in service. That information is not given. But the problem will say, this is a neat question, the problem will say, had this building been sold by a trust or estate, the recapture would have been. If this building had been sold by a trust or estate, the recapture would have been. Now let's think about that. We know in the problem what the accelerated depreciation was that was taken. We know what the recapture would have been for a trust or estate. With that in mind, what could we compute? So you know the accelerated depreciation. What's the recapture for a trust or estate? Excess of accelerated over straight line. Yes, Don is right. So you know what the accelerated was. You know what the excess of accelerated over straight line was. So with that in mind, could you not compute straight line? Think about that before next week. The problem wants to know what would be the total recapture. So it would be the excess of accelerated over straight line, which they basically gave you, plus 20% of straight line. And you had to back into straight line. So think about that. If we need to go into more depth next week at the review, we can. But it's an interesting question. Without advanced guidance, I think it would be very unfair. Let me just repeat it again briefly here. Corporation's going to sell an acres building, a 1250 asset. Question wants to know what would be the total recapture. So that would be tiers A and B. They tell you what the accelerated depreciation was that was taken, but they don't give you the life. So you can't compute straight line directly. But they tell you in the question that if this had been a trust or estate selling the building, the recapture would have been. So if you know accelerated depreciation, you know the accelerated, and you know the excess of accelerated over straight line, you can back into straight line. Take 20% of that straight line, add it to the excess of accelerated over straight line, and you got a pretty nifty problem. 1/3 of you will get that. Another 1/3 of you